Good evening. This is Gil with a Cliff Notes version of my mortgage-backed securities and real estate update with Evan Beach today. Just trying to make a more digestible version of our half-hour call from today. This is just a quick reminder that I'm a dumb shit and I don't know way more than I do know, especially when the experts don't know what the hell's going on. Today we talked about the mortgage-backed securities market update. We talked about the forbearance program that's coming out and why you should pay your mortgage as long as you can, and the forecast of what's going on with the little LOL there because nobody really knows what's going on. I recorded a separate video that kind of breaks down this mortgage-backed securities article that Evan put out, but that's what I highly recommend. So quickly, in the mortgage-backed securities market, this is all based on this mortgage crisis and Fed unintended consequences article. Kind of breaks down the difference between an originator, somebody that you would call to give your credit report and your 2 years income and all of those things to get a loan. And then once it's actually created and it closes, then it goes to a servicer to collect the payments and then forward them off to an investor like a pension fund. There's been a total disaster in that market and liquidity crisis based on all of the leverage that's been happening because of all these refis and the way the market has been versus what the Federal Reserve's impact on trying to mitigate the crisis from coronavirus has been. They've kind of overkilled on that, and it's actually made mortgage rates rise while the Fed funds rate has lowered because all of these servicers are trying to hedge all their risk, so they're freezing up the mortgage market. This article breaks that down way better than I ever could, but the long and the short of that is they're really trying to stabilize that. They've had a little bit of success stabilizing it. So in terms of rates, things are sort of business as usual can be, is what I think Evan phrased it as. But we'll see where that goes moving forward. What that means for buyers is you can expect delays. You can expect increased scrutiny and standards. If you're just starting the process, you should definitely have your ducks in a row and have all your paperwork in order. It's now more important than ever to go with a super qualified professional mortgage loan originator, somebody that really knows what's going on in the market, has experience, ideally from the last crisis, and in a perfect world, somebody that might service their own mortgages because they might have more flexibility in terms of what they can offer you right now, because Quicken Loans or even the bigger banks like Bank of America and these huge servicers that are having this liquidity crisis are trying to mitigate that by freezing new loans so that they are not exposed to any risk and not tying up capital until they clear out their pipelines. So it's really important to go with the pro. And then to that point, if a rate does happen to fall into a window that you like, you should tell your mortgage loan originator just to lock it for you, essentially. So if you've got a good pro, you can trust them to lock it for you when they see a rate fall within a range that makes sense for you. And if you like it, lock it and move forward. Because generally, historically, we're still in a really good window of rates. For sellers that are in the process, if you have a buyer and you're under contract, they're your new best friend. You started this process with all the leverage in the world in a really hot seller's market. But now you need to understand the environment you're in, not be stupid, and kind of kiss their ass through home inspections and things like that. I would not really want to go back on the market if I was under contract right now. So you should really have your agent understand that scenario. Your agent probably definitely understands that scenario if you're working with somebody good. If you're not under contract yet, you should definitely have your agent scrutinize buyers a lot more. When was their pre-qualification letter issued? And then who was it issued from? Are they frozen? What's their current status for financing? And what's their current income and their job status? What do they do for a living? Where are they going? How are they going to make their money? Are they going to be able to prove that income to their mortgage, and will they actually be able to close on the transaction? We've got to be a lot more diligent about that moving forward. If you're not on the market yet, nobody knows exactly what's going to happen. Digital traffic is way up. Showings are still happening. It's supposed to happen on a one-on-one basis with no open houses. There will definitely be some pent-up demand from people that were in the process that are still looking for houses. We don't know how that's going to shake out in terms of people's job losses versus pent-up demand. And it's definitely going to be a few choppy months as we come out of this thing, and maybe a couple years. So I would definitely be, if I was thinking about listing my house or just about to list my house, I would definitely be prepared to be super quick to market, and I would be prepared to be super fast and flexible in terms of pricing in the market. I think there's going to be a golden window um, as we come out of this thing uh, to be right on the market and come out strong with the people that are still there and that pent up demand. Once that kind of diminishes, it's anybody's guess is what's going to happen based on the macroeconomic conditions. Then we switched to forbearance, and we talked about uh, that the government is going to provide 90-day relief for fees and charges and things like that. And then talking about your credit score and things like impact on your credit score. So we kind of recommended that this is probably something to use in a last resort. And I put this picture up from Goodfellas to kind of describe that. If you read the fine print of this, it might say that it says no credit score changes for accessing relief. The moral story is you're definitely your mortgage has been sold to somebody and they're gonna want to get paid, just like Goodfellas. So you may get a break from paying for a little bit, 90 days or whatever it says right now, even if they extend it, but you're still gonna be accruing interest more than likely, and you're probably gonna pay more over time. And while it says that there should be no impact on your credit score, Evan's guidance, and I would be as skeptical about this too, just the actuality, the letter of the law and what is actually happening on the ground between credit bureaus and banks and records and things like that. I just would not want to take the risk if I didn't absolutely have to, in terms of a ding on your credit for that. So the upshot of that is if there's any way at all you can stay current on your mortgage, we highly recommend that you do that. Then we got into a forecast. The Fed is going to continue purchasing, but hopefully at a more sane level for mortgage-backed securities, which should help stabilize the market. That whole entire industry has been lobbying the Federal Reserve and Washington to tame that down, and with the goal of stabilizing the market. And then there's probably going to be some sort of federal intervention on servicer relief or a bailout for the companies that service mortgages to allow them to continue with liquidity in the market. Supply and demand is anyone's guess. All these factors that are here are going to shake out to one extreme or the other over the coming months. And everybody's just generally uncertain about it. But like I said, there's probably going to be a narrow window of a month or two or several weeks or the first month or so as things start to come out of here. Days on market is going to be less important because everybody understands that we're in uncertain and totally unique times. So threading the needle on all these factors is going to be really important as we come into the spring, summer season or post-coronavirus selling season or real estate market in general. I think that the macroeconomic thing is not looking good in the long term. I'll talk about this more. I think V-shaped recovery. V is for very unlikely, in my opinion. And my opinion is just kind of believability weighted decision making off of primarily Ray Dalio. But you can see this black line here on, I can't point to it here, but the black line on the left of this chart is the depth and severity. We're about 15 to 30 days into this crisis. And if you look at 2008 and 9, the green line lasted about 300 days till we kind of bottomed out. And the other ones even longer. In general, crises have been shortening in duration, but steepening in severity. But I don't think I don't think this is going to be a 2-week or 3-week kind of thing. I think we're in for quite a rocky road moving forward, but we shall see. I'd love to get any feedback or questions for future topics to nerd out on here. This is my handle on social, and here's email if you want to shoot me anything to reach out. Appreciate you tuning in. Hit us up with any comments or questions you got. Cheers.